CVS stock has fallen about 40% from its peak in 2021. This company purchased Aetna, the healthcare insurance company, back in 2018. They've made a couple other acquisitions of healthcare servicing companies, insurance companies over the last couple years to help them get away from their retail consumer brand and the pharmacy locations that they have, which have struggled with the both pandemic lockdown, with the Amazonification of the entire retail business, and with some of the theft that's going on over the last several years in the U.S. That business has struggled extremely. The stock has been absolutely hammered. It's down 40%. But yet revenue is growing and earnings look like they could be moving upwards. This might be a bottoming and what could be a very interesting play for outperformance if you're long-term risk-taking investor. Let's take a look now at CVS. We're going to update our forecast for this business and go through their recent earnings release to take a look at this business. You ready? Let's get to work. Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thanks so much for watching the channel. I greatly appreciate it. This week up, we're going to take a look at CVS Health, the multi-billion dollar, $370 billion a year annual healthcare and retail company that provides pharmaceutical services, pharmacy services, as well as a very legacy retail company. But their most recent venture into healthcare insurance is really where they're trying to take this business. We looked at this stock many years ago, and when we looked at it in the lens of, hey, if they're moving into healthcare insurance, they should be at a market multiple premium akin to the other healthcare insurance companies out there, such as a United Health Group that can trade at the 20 times range. This company trades for single digits. There is a large market multiple expansion opportunity in this business if they're able to pull off the acquisition, integration, and eventually shifting from a retail location, kind of vending machine-ish kind of company that's selling goods and services, over to a healthcare insurance company with recurring members and annual payments in the hundreds of billions. That is a shift that's going to take multiple years to do. We were interested in the stock a couple years back. Revenue has continued to grow nicely, but earnings have struggled as they've tried to integrate these two businesses and hit roadblocks. There's a new CEO. Let's take a look at these most recent earnings of the company and see what we can learn. Okay, so here we are with the earnings report, February of 25. This is the Q4 earnings for CVS. Let's see, delivered revenue growth of 4.2% and adjusted EPS $1.19 for the fourth quarter. Issued initial 2025 adjusted EPS guidance of $5.75 to $6. Now, we don't really pay attention to EPS here because they can manipulate the share count, but I want to get to revenue and earnings. That's what I'm going to really focus on. Full year guidance for 2025, at least $386 billion of top line revenue. That is revenue growth over prior year. Adjusted operating income of $13 to $13.5 billion. There you go. There's your operating income, right? Now that's akin to an EBITDA. It's enterprise level earnings. And the total company adjusted EPS, like I said earlier, $5.75 to $6 a share. And operating cash flow here, $6.5 billion. That is most likely their cash flow from operations less CapEx. They should generate about $6.5 billion of operating cash flow. Accelerating opportunities to drive integrated value. Integrated value, that's fancy speak for people are getting fired and they're merging two companies together. So increased Aetna's membership coverage 12%. Well, 12% year-over-year growth in membership of a healthcare insurance company is pretty good growth, I would think. Let's see. Increased Oak Street Health at-risk membership 35% year-over-year. I like both those numbers. Those are going higher. Let's take a look at consolidated results. This is 2024 revenue. This is not the page. Here we go. 2025 guidance. For total revenue, we said this earlier, $385 billion. And cash flow, CapEx, there's your CapEx, $2.8 billion to $3 billion of CapEx, and weighted average diluted share count, 1.27 billion shares, slightly more than where they landed end of Q4. So they are still growing the share count here. They're not buying back shares just yet. What I wanted to get to is quickly the breakdown of a couple of their individual departments. So the healthcare benefits department, this is what the insurance business is all about. So $33 billion in Q4 versus $26 billion Q4 of 2023. So they've growth year over year there. Where is the operating income for the business? Adjusted operating income. This is $1.5 billion to $2 billion. These are $1 billion versus Q4, $310 billion. So they are up, reflecting the view of additional cost cutting that they've been engaging in. So they're expecting this business to grow in earnings, which is great to see. We need them to pick that up. Health services business in Q4 of 24 versus Q4 23, slightly down in revenue, $47 billion versus $49 billion. Earnings slightly down, $1.76 billion versus $1.86 billion. So slightly down there. Pharmacy business, revenue was up $33 billion versus $31 billion year over year. Earnings down slightly, $1.8 billion versus $2 billion. So kind of a mixed bag there. They got some membership growth, some earnings growth, acceleration in the health servicing business, but the retail business earnings continue to be a little weak, and the health service business earnings continue to be a little weak. Let's forecast CVS and see what we get. All right, so we're going to go through the cash flow one page here in CVS. Andre's done a great job forecasting this business. I want to review the 5 key factors that we use to value stock here in the channel. Number 1, top line revenue growth. Is it growing? Number 2, EBITDA enterprise level. Can we grow that? Do they make strong free cash flow? Do they have low debt? And if you bought it today and held it for a decade, could you possibly beat the market? Meaning, is it well priced? Let's take a look at CVS Health. So CVS revenue, 2015 to 2024. Remember, they made a big acquisition in 2018. You can see it right here. To $194 billion of top-line revenue, skipped to $256 billion the next year. So that $60 billion jump in revenue is the Aetna acquisition. What I liked is that it's continued to grow from 256 to 268, 292, 322, 357, and 372. That's pretty decent growth. They've added $100 billion in revenue in 4 years. Let's just step back and appreciate that. That's up 50%. May I call it a third, actually, from $300 billion to almost $400 billion in 4 years. That is very strong revenue growth from a business that you would normally not think of, given everything that's going on in the retail pharmaceutical bad press section. Revenue at $100 billion of revenue is quite impressive. EBITDA has struggled. So post-acquisition 2019, they had $16.3 billion, and they got a step up there to $18 billion the very next year. Okay, then it was kind of flat 18 over 18, and it dropped to 12. Must have had some write-downs there, some problems integrating, really lost ground, lost $6 billion of profit in that year. Or they still made money, they just made less by $6 billion. Just want to clarify that. Then it looks like they rebound. I don't know what they did, but they were able to kind of rebound that to 18 and then back down 13 again. So they're kind of hovering in this zone. What I like that I saw in their earnings releases, they are expecting a pretty sizable, about $1 billion step up in earnings over 2024 in their health services business. So hopefully they can pick that $13 billion up. Debt here is a problem. So debt currently $82 billion. That's both the lease obligations for their retail chain and also just general bank debt that they have. So let's Let's see if we can't figure out how much bank debt they have on their books. Okay, so here it is. Let's go get the 10K that CVS just released. Take a look at their debt that they have. So here's the balance sheet, 2024 column. We're going to skim down to total liabilities here. Let's see, healthcare, accrued expenses, liabilities, other insurance liabilities, current portion of lease obligations, that's the rent that's due this year, short-term debt, $2 billion, current portion of long-term debt, $3.6 billion, that's about $5.6 billion. Lease obligation, long-term debt, there it is, $60 billion plus the $6 billion. So they have about $66 billion of bank debt, not lease obligations that if they had to close a location, they could settle with the landlord and get out. This is hard money debt that they owe every single dollar to the bank. And if they're unable to pay it, they'll go into the court system and the court will liquidate assets or restructure the business to pay the bank back that money. That money is in front of you as an equity holder. So I want to pause here for a second and cover something very, very important. The capital stack of a company. What is that? That is the triangle, if you will, of who put money in the business and what priority they sit if there were to be some kind of liquidation or bankruptcy case. So the very first, the highest priority you have in a company is actually the payroll. Management of businesses, executives can be punished personally if they knowingly that they don't have the money employ employees to work for a business knowing they're not going to be able to get a paycheck. So the very first people to have claim on the business is actually employees as the first person to get paid or first people to get paid. After that, it's typically your vendors, your AR vendors, the people who you bought supplies and inventory from. After that might be fixed assets or equipment lenders that lent money to pieces of equipment. After that, your bank, your senior secured lender. That's when we talk about having 3 times leverage or less. This is like a mortgage on your home. After that, you get into your junior debt or mezzanine debt. That junior debt might be something like a higher interest loan. It could be, it could PIK, not paid in cash, but paid in kind. After that, you get your preferred equity. Preferred equity is basically a stock, a class of stock that's issued ahead of common stock and comes with a preferred coupon that has to be paid before any dividends are paid to common stockholders. And then finally, at the very end, the very back is the common stockholder, the you and me, the people buying the stock in the stock market. Those are the last in line to get any dollar. What you want to find a business with less than 3 times debt to EBITDA. In this instance, the business has 6 times. The 6 times leverage ratio right here, 6 to 1, is a problem. It's very high, and it's going to take them free cash to buy it down over time. Otherwise, this company's remain leveraged. So they're going to have to spend their cash that they generate, that $6.5 billion of operating cash, paying down that debt. Or if they don't, you and I as equity owners need to understand that we have a lot of leverage in front of us, and they really do need to grow their earnings to be able to right size that number. If earnings revert back to 18 billion, they're going to be in a much better position to pay off that debt. So if they have $82 billion and right now they're at 13 times EBITDA, that's 6x. If they grow earnings to 18 times, that's 4.5x. So you can right size the balance sheet by growing earnings. And if they believe that they can do that, they've done it the past couple years, if they can trim here, trim there, and get those earnings up, they can right size that leverage, and I hope that they can do it. Free cash flow is really minimal. Market cap, $62 billion, very low. It's actually the lowest point it's been in its 10-year history. That's something to note. 10 years ago it was $100 billion prior to the acquisition. They've bought Aetna, they bought two other businesses. It's now $60 billion. Those acquisitions have actually cost the investors market cap. You can see it was $130 billion right after the acquisition in 2021, a couple years after. And then it's just done nothing but halved in value since then. EBITDA, enterprise value is following the same. So over the decade, enterprise value has returned 0 growth. That's a huge problem for the business. Adjusted free cash flow growth rate here is 0 over this last decade. Again, that starts pre-Aetna and then post-Aetna. So there's some acquisitions here that should be higher, should be higher because of those acquisitions. And it was. Immediately following the acquisition, it was 15 billion, 17 billion, kind of followed EBITDA up, down, and then most recently down to 8.5. They're saying the cash flow from operations should be 6.5, and I couldn't tell if that was pre or post capex, but either way, cash flow is going to be light for a while as they continue to turn this business around and grow earnings to generate more free cash flow. What you're basically looking at is a stock that's going to produce about $4 in free cash flow annually. If they choose to pay down debt with that, your cash flow could be zero for a couple years until they buy down the debt to an appropriate level and then unlock that cash to the equity holders. So here we got a brief forecast. We're saying that by 2027, they're going to get back up to about $17 billion of EBITDA. That EBITDA is less than what they produced prior, 18, so it hopefully is some sort of conservative number. And then over long term, they're going to grow at about 3% a year. You put a 9 handle on that, you get $183 billion of enterprise value. You can bring that down to about $81 a share. Do the same thing on free cash flow, you get about $83. So right now you look in the stock market and you say, hey, I can buy all the stock I want for $65 a share. Against the $4 free cash flow, that's about a 7% free cash flow yield, assuming they don't buy down any debt. If I hold that for a decade, it grows to $82. I get a pro rata share of earnings. I get a 15% IRR. Very interesting. I mean, certainly higher than the market is expected to return. You got some issues with leverage here and some real concerns. So let's recap CVS here. They are growing revenue, actually very interesting. I think that's the biggest highlight here is they've added $100 billion in revenue over the last 4 years. And if they can turn that revenue into profit by cutting costs, by being disciplined, by synergizing, that should come down to EBITDA. It should translate to free cash flow. It should normalize the debt ratio. And it should produce strong free cash flow. Those are all shoulds, though. So that's really what you're gambling on here. And as a result, if that were to pan out, you would get a market-beating return of 15% annually over the next decade if they can do that from this point. So it seems like it's fairly risk-adjusted. I wouldn't mind seeing it a little bit cheaper, maybe closer to the $50 mark on stock, just to make sure you're really getting enough cushion before diving into the stock because it's been incredibly volatile. I love the story of this stock, that they're moving away from the retail and going into the healthcare services. That healthcare services typically has a huge market multiple premium. So I think there's a lot of opportunity to be upside here if they can pull it off. So tremendous execution risk. Love to see the new CEO and management really execute on a quarterly basis and be brutally honest with investors about where they are in the timeline of making this transition. As far as the 5 key factors, revenue checks the box. That's growing. EBITDA is growing. Free cash flow, I'm going to say no. Doesn't feel strong yet to me. And debt is very weak. It's 6 times. Can't pass that one. But is it well priced? Yes, it does look like in terms of a stock price, it could actually return if you can handle the leverage risk and wait for free cash flow to materialize for you as the investor. All right, this has been a fast review of CVS Health. Let me know what you think in the comments. I reviewed this stock many years ago, liked it at that time, got burnt on it, so I hope maybe it's bottoming here. We'll see how it goes. Leave me a comment down below. Let me know what else you'd like to see. Join the Cash Flow Club at cashflowinvestingpro.com. Help support the channel and the hard work the analysts are doing, publishing research like this inside the center. If you want to learn to do this yourself, I highly recommend you take my investing course, my cash flow investing course. I will teach you to do this. I will give you an Excel sheet. I'll walk you through how to enter the numbers, how to calculate revenue, how to calculate EBITDA, debt, what is operating debt, what is bank debt, how to get a yield, a market multiple, what is free cash flow. All of that is wrapped up into a very basic course. I've had tremendous success with people and had great feedback from those who've taken that investing course. My background is as a CFO. I run companies for private equity businesses. I've been doing this at the board of directors level for 15 years, merging businesses, buying, selling. I was participated in an IPO process in 2015. So I've done this on a corporate basis, and I'm trying to teach everybody on the internet how to do practical finance where it's cash flow based, get away from some of the meme stocks. And I did a course. Check it out on my website, or join the Cash Flow Club, and I'll feed you investment ideas like this on a monthly basis. Let me know what else you'd like to see. Happy to take recommendations. Don't forget to like and share. Throw a comment down below. Always helps the algorithm. Okay, thank you very much. Take care. Bye-bye.